used to be a 60-40 portfolio, 60 equity and 40 debt, but it's changed to 70-30. I have not had much allocation to small cap yet, but going forward, I will add small caps for sure. The more you go beyond English, a lot is there in India. My wife introduced me to investing in art, and that's taken a very serious step. People highly underestimate the power of a 12% return compounded over 15-20 years. And 12% in India is achievable. And biggest miss was not working on gold. But what I know is in the next 15 years, manufacturing is what India is all about. I personally feel next 10 years belong to healthcare in India. There's no country like India. So I think in this entire tariff regime, India has a lot to gain. I mean, typically unemployment is something which is brewing at the back. Our growth needs to be above 6%, and that's a question mark now. So all those will kick in after 8-10 years.
Welcome to the new episode of Guru Portfolios, where we quiz ace investors, fund managers, and leaders from the financial world about their personal investment journey. In today's episode, we have with us Swarup Mohanty, who is the CEO of Mirae Asset Mutual Fund, which is among the few foreign-owned fund houses left in India's ₹67 trillion mutual fund industry. Hi Swarup, welcome to the latest episode of Guru Portfolios. It's great to have you here.
No, just thank you so much for doing this with me. Like I said last time, this is my yearly review of my portfolio, so it helps me a lot.
Right. So Swarup, can you tell us about your asset allocation? How has it changed over the past year and over the past 5 years? And then maybe we can drill down into, finer aspects of your personal portfolio.
I'm a very boring investor. It's very mathematically driven. I think earlier, before 5 years, it used to be a 60-40 portfolio, 60 equity and 40 debt. But it's changed to 70-30, and I've been maintaining 70-30 for a long time now. 70 equity, 20 debt, and 10 to alternates and some collectibles. So that I maintain very, very rigidly.
Okay, sure. And over the past year, how has it changed?
Not much, actually. I mean, what is changing now is earlier it used to be large cap and flexi cap heavy. But if you see in the last post-COVID, most of the public issues have come in the mid and small. So taking cognizance of that, a little more shift towards mid and more towards thematic is what I'm doing. Still no small caps yet, but a shift to more mid and thematics especially.
Okay. So we'll come to your market cap split in a bit. But how has your portfolio did over past year? And since this is also the 5th year of Guru Portfolio series, how has it performed over the past 5-year period?
A 5-year would have done well. I think portfolio returns would be around 22, 23, or maybe a shade above 23%. But last year, I think would be around 6 to 7% would be their returns. Some worked, some didn't work, but it's been a mixed bag for the last 1 year.
Right. And what worked, because markets have not been that great over 1 year period. So what worked for you in your portfolio?
I think the thematics worked. Being large cap over Nifty 50 worked because large caps outperformed the benchmark. Moving into thematics, I think my healthcare, which continues to be my favorite in my portfolio. Healthcare, being in banking, I think safeguarded me from the
healthcare is the ETF.
No, healthcare is my active fund. Healthcare banking is split into two sides. I mean, those and I think we added the Make in India, which is a good manufacturing ETF from our side. These three worked for me. I think not having small caps saved me from the downturn, and IT didn't work for me. I think global IT worked, but because of global funds being shut, I could not allocate mark. While that did work, which is a small part of the portfolio, but Indian IT sort of took a hit. Being long in debt has helped, and then clearly some of the allocations to collectibles have helped.
Okay. And what about what didn't do so well for your portfolio?
I think last year, if you see, if you take out the IT part, rest have helped me well. I think not being greedy has helped me well, and sticking to the mathematical grid has helped me. So broadly, if you see last year, I'm not faced by the downturn or the impact of the market because I was not there.
Right, sure. And Swarup, within your equity basket, what's your active and passive split?
I think we're going 75-25 now. I think on the passive side, I mostly into the thematics more, and that's broadly helped me last year. I had a little bit of Nifty 50, but that I had to sell for some other reason.
Right, sure. And going forward, do you expect this, active passive split to maybe go further in favor of passives from what it is now?
Yeah, can. I'm a big fan of rule-based investing also. So maybe 75-25 can go to 60-40. I'll watch some of the algos playing out. I mean, too early sort of comment. But yes, it'll go a little higher than what it is today.
Right. And what about your market cap split across, large, mid, and small cap within your equity basket? How is that split?
See, it used to be very large cap heavy, but the markets broadened. The choice for fund managers on the mid and small have increased. So I'm taking cognizance of that in my portfolio. It is still 60-40, but going forward, it will become 50-50. I have not had much allocation to small cap yet, but going forward, I will add small caps for sure.
And Swarup, when it comes to spending, do you track your spending on a monthly basis? Is there a tracker that you maintain? And also, do you also, review your personal balance sheet at the end of every year, or quarterly, or any frequency that you follow? I mean, do you also do those things, which financial planners often advise?
I think two things. I started this in 2012. One is keeping track of your money. So I strictly have an income expense statement, which I reconcile with my bank on a monthly basis. That helps me keep track on my spending, because once you keep track on your spending, then you can, have a overall measure of your money. And yearly, I do a net worth statement, which includes all my monies, which is my PF, my NPS, my mutual fund investments. I have some annuities, and then I put the whole thing together minus my liabilities from that, and then come to a figure of where I stand. I'm a paranoid retirement kitty person, so if I don't know where I stand, then there's no point doing a review. These two have really helped me keep on track for my retirement goals.
Right, fair enough. And also, Swarup, a lot of youngsters, and I mean, not just youngsters, but everyone now uses credit card a lot. So how do you keep track of that? It becomes a black hole for many people.
Like I said, once you have the income expense statement in place, you broadly know how much you're spending on your credit cards. My spending on credit cards has different heads. I don't think I add many new heads to that, but broadly I keep track of how much I'm spending in a month, and it's always sane to do that. I have two credit cards, but I use one. Okay, and then in that, my biggest objective is it should give me a good redemption points on my travel. If I can do my personal ticketings from that, it really helps.
Right. Sure. Now, getting back to your, investments, what about your international allocation? How much is that? Have you been able to add to it at all?
I think that's been the sad part. While I would have liked to allocate more, but right now there are no options. Thankfully, we're now launching a fund on the Gift City. Hopefully, should be able to add on that one. But international investing being stopped has hampered my ability to invest globally.
Okay. So, but roughly what percentage of
It
your
used to be 10% at one point of time, but clearly it's now below 4-5%. It used to be big.
4-5% of your overall portfolio?
Overall.
And also, can you tell us a bit about your alternates? How do you go about evaluating, those investments? Where do you invest? What's the process there?
Actually, some friends started building companies and gave me the opportunity to be part of their company. So that's how one got introduced there. And some good friends have, over a period of time, built some good companies. So they gave me this great fortune of being part of that. So that was one. But then, like last year, we explained, my wife introduced me to investing in art, and that's taken a very serious step. So very lucky to have been exposed to some incredible artists in India, and that I will continue to nourish and develop as a passion. Not yet a passion, but still, then just understanding that whole what can I say, environment of art and artists, and the way it's done is very fascinating.
Right. So how does it work? It's like your wife takes the investment call, and then how does that whole dynamic work
See,
between?
we put a broad allocation of how much we'll invest there, and yes, she does everything.
She does the groundwork.
She does the groundwork. She checks the artists, and by this now we have a wish list of which artists we'd like to own, and who are those galleries we deal with.
How do you guys deal with? Sorry to interrupt you. There is an opacity when it comes to art market compared to mutual funds where there is daily NAV, or equities where markets.
Don't agree with that. I mean, once you get into that circuit and you know various good galleries in the country, there is a broad amount that you pay per painter. And over the years, good painters have only increased their prices and their tradability. It is not very liquid, I agree.
Right.
But I don't think I'm buying art to sell in the near future at all.
Okay. And in your, I believe startup investing that you were referring to, what can you give us a flavor of the companies? These are obviously need not name them, but anything interesting.
A very dear friend started a health tech and it's doing phenomenally well. Another friend, I am a big fan of OTT and I am part of an Odia OTT also. So similarly,
a regional
OTT. See, India is about non-English, right? And more you go beyond English, a lot is there in India.
Sure. Got it. And Swarup, as you are, now about 54, 55, and you're planning for your retirement, are there any particular categories within equity that you would rather not invest in? Or how do you invest in different categories? We have flexi cap, we have multi caps. Or do you prefer one over the other? Can you tell us a bit about that?
Yeah, broadly, I'm more a large cap flexi person. I'm very careful that the flexi cap should be a flexi cap and not a large cap in disguise. So I have certain fund managers there who I follow, and I'm a big fan of some of them. So I stick to the fund managers more than anything else and my choice. And to be fair, the fund managers have delivered over a period of time. And to be with them in their good and bad days actually rewards in the long run. So that's something which I've learned. I think my portfolio construction for my retirement is between 11 and 12%. That's the desired return of the overall portfolio. And over the years, I've realized that people highly underestimate the power of a 12% return compounded over 15-20 years. And 12% in India is achievable. See, I can't go wrong on my retirement goal. So there is that much risk I would like to take in that portfolio. But as I discussed, last 2-3 years, the markets has changed. So the cap, which was mostly skewed to large cap, will start expanding more towards mid. It was mid heavy because my favorite fund is Mirae Asset Large and Mid, where a lot of my money is. That took it to a mid segment, and I do invest in mid caps because I do believe India is about mid caps. But slowly, the small caps are giving fair amount of possibilities in the market. But from here on, maybe 5-10% to small caps can happen.
Okay, and how much of your investments are? Is it only Mirae schemes, or you have some non-Mirae schemes?
No, 80-85. But I think I dare say there is this insider trading which has come up now. So for liquidity of portfolio, I have to invest outside Mirae right now because a lot of my core funds have SIPs. So if I am on SIP there, then redeeming cannot happen. So for my need, I have to invest a little outside now. But broadly, 85% of my portfolio is and will perpetually remain.
You mean the skin in the game rule?
No, skin in the game is different.
Right. Right. Fair enough. Yeah.
So if I bought a fund, I cannot redeem for 2 months.
Right.
So there is that clause.
Got it. So that's also the reason you have.
So I have to keep.
Right. Got it. And Swarup, when it comes to your retirement goals, how are you as a retirement planner? Are you more on the conservative side? How do you mentally approach retirement and planning for retirement?
So I'm a paranoid retirement kitty person. Two realities. One is people are going to live longer. And so one realization is that I have to be healthy. So I've started investing on the health part. A little late, but there I durust hai. So that's one part. I don't want to be unwell at that age, right? So the biggest fear I have is most people plan for 80 years. And if they start living beyond that, that's when the money comes into a big play. So it's better to start planning for 1995. So that's a long time, because it's almost 20, 30 years of passive income that you will need. And with your lifestyle expenses slowly but surely increasing, one needs to really plan for a large retirement kitty. And for people like you and me who plan to live in Mumbai, that expense actually amounts more. So I am absolutely clear of how much money I'll need, and that's a fairly large sum for a salaried person like me. And that's why from here on, the amount of investing that I have to do is a lot. But it's a calculated amount, and it will be done. I mean, I cannot not have that money at that point of time.
So how much are you able to save? Like, what's your savings rate? If you can give some.
Now I've gone up to almost 35%.
35%
net take. Only if I don't do that.
More than 1/3 you are.
So that's where the income expense helps. So if my expense is kept in check,
Right.
this can happen. And if some amount of trimming of expenses can happen, see, when you start working, you start fulfilling your fantasies. After a point of time, you have to control those fantasies. From here on, like you said, I am 54. I have that many years of work life left. So the amount I have to invest is fairly large to reach that goal.
Right. And since you, I was going to ask this later, but since you spoke about health, what you do, how do you, stay fit now that you started it?
Actually, my son took me to the gym. He said, "Dad, enough is enough. Let's go." So he took me to his trainer.
Okay.
So I do 3 days a week, and the other 3 days I could have done better. I'm trying to figure that out, but hopefully I'll get there. But it's almost 1.5 years, and tried to work on my weight, some health issues because of my thyroid keeps my weight loss a big problem. But I worked on it. But I think if we do this next year, hopefully, his face will look thinner.
Kapo jola.
Yes, let's see.
Sure. And what about your life cover, health cover? Is there a way, also for the benefit of our viewers, is there a way that one should go about calculating one's life cover?
So I'm a little paranoid on my health, and this was post-COVID. I think that was discussed a lot over last year's portfolio. But then I thought maybe I was a little too paranoid. So I was 4 crore last year.
4 crore health cover. With your personal health cover.
Personal health cover, which I've got down to 3 crores now. So that's one trimming which I did last year. I think 3 crores is good. I was a little paranoid, but little structured on my insurance cover. First step is to cover all liabilities. I have a home loan of 4 crores, so that's my first step.
Which went up after.
Because I bought a house. My son is now staying with me, so we need a slightly bigger space. So I'm shifting on that. But I sold my present house, which paid a large part of that, and so I had around 3.5 crores last year, which has gone up to 4 crores. So my first step is to cover that, and second step ideally should be to cover the rest of your work-life income. And two parts to it. I can do that, but my portfolio has become okay so far. We've crossed certain thresholds between me and my wife when we discussed the amounts. I think we've crossed some much. So I'm not able to cover the entire part, but I'm okay covered there. But at the same time, my work insurance is also there. So broadly, that is the maths I cover. But if you put my portfolio into play, then my not being able to cover the entire work-life earnings is a trade-off.
Okay, sure, fair enough. But again, this is may not be may help our viewers. Like, what should be like ideal? Like, should there be a cover of your debt?
Yeah,
in the sense,
I read this somewhere and I thought it was very logical.
Right.
First step is to cover your debt.
Right.
I mean,
should there be a multiple to that idea?
I think one time is good, because the last thing that you want is your family to go borrowing money to pay your debt. That your family should not. So that's step one. At least that frees up people. The second, like I rightly said, is you have to calculate your work-life income. Right. And if you can put a compounding to that, compounding of
inflated in certain way,
or at least inflation adjusted, that should be the amount. So your debt plus that should be the cover. And if you start early, you can do it very easily with a term plan.
Right. And you get more premiums are better. Another thing, I think when it comes to your retirement, is it, I should have asked you earlier, but is it like your own cover, or you look at own corpus target, or it's like your combined target, your wife separate and you separate?
No, two different portfolios.
Okay.
So see, I mean, since I'm the earning member, we cover
Right.
myself,
Right.
right? Logically, that's what it is. I mean, over the years, her portfolio has become
Our retirement portfolio is also
She runs
it's
her
separate.
retirement portfolio. I run my retirement
Okay.
portfolio.
Parallel.
My son runs his portfolio. So
Okay.
three different portfolios,
Okay.
independent of each other.
Okay.
Though we all know how much money we have,
Right.
down to the T,
Okay.
and so
Sure.
everybody knows each other's.
Sure. Fair enough. And right, and I think you did mention your outstanding debt is you had, I think, last year a car loan also that you have
That I paid back.
that you paid back. Okay, only it's the housing loan.
Yeah, just the housing.
Right.
That I can, but see the home loans have corrected the interest rates,
Right.
and I think I'll carry that much, and because my investment portfolio is yielding higher than this,
Right.
might as well carry both.
Right. And Swarup, what about things you think you could have done with your portfolio? Maybe it was a miss for you, in the past year.
I mean, biggest miss was not working on gold.
Okay.
There was a house call, there was a personal call, but just not working on it, I missed a big opportunity, huge unlearning for me. Not exactly unlearning it, it's a terrible loss. I mean, I could have worked on it. I mean, if you Google me, you will see that we had given up a blatant call, but I stuck to my mathematics. If I would have, and that's a learning, maybe going forward, be a little more vigilant on portfolio allocations. I'm very mathematical. Maybe work on some allocations a little bit more, and if I can be a little more tactical, I think I can add a little bit more within that risk profile to the portfolio.
Okay, sure. And going forward, how do you see your portfolio changing? Do you see maybe some new categories coming in, or you see new investments maybe on alternates, or maybe in your solid mutual fund base that you have? Do you think there needs to be more work done there?
No, I think I see this next 8-10 years as the best, probably 10 years for capital markets in from an Indian market perspective. I want to front end most of my financial goals in the next 8-10 years. That's my goal, and from that perspective, a little more allocations to thematics will help me, and more, I think, accumulation of small caps. I'd like to accumulate IT because it's at a great price. I know it's a negative on my portfolio, but these are prices which you will not get for those stocks. So maybe a little more vigilant on such opportunities, which I was not, I think, is what it will be. I think watch factors versus active a little more closely, and see who wins. I can choose both. So that's the beauty of being an investor now. And still being more active on the debt side can add some more of my portfolio. The whole point I'm making is it used to be a very boring portfolio, but I have this 8-10 years of opportunity left. Maybe a little more vigilant and a little more active to my portfolio will help me a little bit more, is my view.
What about your travel plans? Because we know that you are an avid traveler and you are also a wildlife enthusiast. So what are your plans in the?
No, I just did Tadoba last weekend, 47 degrees, but 12 individual tigers.
Right.
It was just unbelievable, but the age is catching up. 47 degrees, maybe I'll rethink next year. But yeah, I mean, I'll do it in not this much of heat, but that will continue perpetually.
Right.
Travel is your best investment. I mean, you're meeting different cultures, broadens you as an individual. And that's been the best thing that I could have gifted myself. And that's also a big credit to my wife who plans this part. I just go as a tourist. So yes, this year I should do 1 or 2 countries. Let's see if I'm able to do it. But I'd like to drive this year. I want to do the small villages of England if I can, because I can drive.
Right. Yeah.
I'd like to drive this year. Let's see if I'm able to do it.
Okay. And one more thing, you obviously look at thematics, which is in the industry and elsewhere, thematics, always it's not recommended. But how do you approach thematics? And what's your, in the sense, is it because a lot of people, I believe, also look at thematic as a short-term tactical bet. But how do you look at it, and what kind of themes you look at?
See, just that's the thing. Even after 20-25 years, people confuse sectors for themes.
Right.
right? You can take tactical calls in sectors, which is fair. See, that is something of a prediction of business cycle. I leave that to the fund managers. I don't predict business. I don't have the capability. But what I know is in the next 15 years, manufacturing is what India is all about. So I will sit tight on manufacturing. 15, 16 years ago, consumption was the thing and it will continue to be. I personally feel next 10 years belong to healthcare in India. So when you look at the strong pillars which drive economy, which is banking, healthcare, consumption, and now manufacturing, are places where you must have a longer term stay. If you look at those portfolios, they are formed of solid large companies, proven companies. So when you look at the risk reward of some of them, you compare any consumption to a flexi cap, you will get the answer. Right? Going forward in the next 8-10 years, healthcare is a no brainer for you. India is a sitting duck of opportunities for healthcare, right? And everybody talks about manufacturer. One is talking, one is doing. We have a fantastic index for ourselves, and I will accumulate this. And so, when you look at the portfolio risk reward that good structural themes can give you, will be far superior than say smaller balance sheets. So it caters better to my risk.
Sure. And there has been a bit of uncertainty on tariffs globally. There's been a lot of noise. How do you see, India placed in whatever we are seeing globally?
See, our chairman, Mr. Hunji Park, put it very simply. He said that India is the only country which can talk to US, Russia, and China simultaneously. There's no country like India. So I think in this entire tariff regime, India has a lot to gain. We have a lot of bargaining power because there is no doubt across the world that this is the growth story of the world. Everybody would want in also here. And we have enough things to bargain with any country. A little bit of oil shift from one country to the US can change a lot of negotiation for us. We allow some of their big companies into this country, which is still, there's so much demand for that. A lot can change for us. So we are a neutral country at this moment, and that's why I said tariffs, non-tariffs, nobody can take away the structural growth that this country offers, and one has to ride this. There are certain risks in the country, but I think they will start unfolding after 8-10 years. I mean, typically unemployment is something which is brewing at the back. Our growth needs to be above 6%, and that's a question mark now. So all those will kick in after 8-10 years. So I'd like to front end the 8-10 years to my benefit as much as I can.
Sure. And on your alternates, do you think it can ever, cross say 10% or it will always be in that?
No, I won't take it below 10%. I mean, I would like to keep most of my money in financial assets and liquid assets. So alternates have their pluses, have their negatives also. So not to be greedy is the whole hallmark of a good portfolio. They give opportunities, but to that allocation.
Thank you, Swarup, for joining us today and sharing all those insights.
No, thank you so much for having me. It's always such a pleasure doing this every year. I started very reluctantly, but now I'm okay.
Great. Thanks. Thank you, sir. That was all the time we had for today's episode. Thank you, viewers, for tuning in today. Hope you like this content. For more such interesting content, keep watching Mint.